Welcome back to Morning Trade Live. Let's keep talking some earnings and let's get ready for Netflix. Ken Leon joins us from CFRA to prepare for the report as we've got pretty big expectations, I feel like, for this advertising business. Ken, is that right?
So Netflix looks great across the board. It's not only advertising, which is a new revenue stream for them, but it's also the introduction of the ad pay plans, 23 million subscribers, and then also for all of that account uh, sharing, that's creating more revenue as well. So Netflix looks great. It's really sitting atop all the havoc that we're seeing with its competitors losing money.
Now this is going to separate them even more. So they're already, seems like a step ahead, maybe light years, and they're going to extend that. So, I mean, does the investment money interested in the category of content and streaming just keep coming to Netflix until proving otherwise?
Well, it's changing dramatically, and we think there's going to be hard decisions made by the second tier players. But you have to remember, Oliver, that Netflix competes with enormous companies in interactive media such as YouTube TV, also Amazon Prime Video, and then Apple TV. So the playing field is changing, but Netflix is really in that first tier group, as they look down to the other companies that in many instances they have too much debt from acquisitions. They are way behind the mark on reaching meaningful profitability, and they're still trying to figure out really what's the right spend for programming and content.
For Netflix, what is going to be the impact of Scott Stuber heading out? This was the breaking news over the last 24 hours. In addition to the wrestling deal, let's start with Mr. Stuber's exit. Does that bring any disappointment, lack of confidence? I mean, how does the market feel about that?
Yeah, so to right size this is, sports rights are very expensive. And we're seeing that, for obviously the NFL. And Netflix is being very smart in terms of their sports documentaries, Beckham, Captains of the World, Breaking Point. So they're looking for ways to capture viewers. The announcement with Worldwide Wrestling is really great with the Raw show. But overall, Netflix has a very attractive outlook. You have over 50 analysts covering this company. You see revenues in 2023 maybe about 34 billion, and then the next 2 years 38, 42 billion. Very profitable. We're looking at earnings per share right now. The street for 23 is $12.25, going to $16 and $20. You cannot find that in the other part of the movies and entertainment industry.
All right, and I guess this Raw deal is going to be pretty fun for the wrestling fans. 10 years. I mean, it's a pretty infamous show within the wrestling category. It seems like a decent deal because there's been a lot of bidding wars, and WWE had like a 10-year rally basically when it was breaking through to different mediums and platforms. So I guess this is a victory.
Yeah, that show has viewers, 17.5 million viewers per year.
Sure.
It will initially be just US. In 2025, Netflix will share that on a global basis. So again, that's the success of Netflix, is not only for movies and TV episodes, but they can share worldwide. In many instances, their content comes from other countries, and then it goes viral around the world, including the U.S.
So you're thinking Netflix could trade above $500, $530, the latest price target I see from you about 10 days ago. Buy rating 4 stars, right?
Absolutely. So to right size this for 2024, we're probably in a consolidation period where the stock trades up or down sideways. It's had a great move in the fourth quarter. But then again, I purposely gave you those revenues and earnings numbers because that's going to be the driver for a higher share price.
valuations right now, the PE like 50-ish, which I mean by Netflix standards is not particularly high, right? I mean, it's high by the market standards, of course, like compared to the S&P, but for Netflix, I mean, it's traded much more expensive in the past when it was less profitable.
Yeah, so for valuation for movies and entertainment, we use total enterprise value, the EBITDA, for all of them except for Roku, which we have a sell where you can't even, because they have no EBITDA, we use price to sales. So PE really doesn't matter here. And then if you're using a metric like TEV to EBITDA, then there's the question of how much debt or leverage you have, and also your ability to drive higher EBITDA growth. Put it all together. Netflix is trading probably below its 3-year historic range on that metric.
What are the risks? Are there any metrics we should be looking for as potential pain points in this? Churn, cost of production for content. I mean, like buying Raw seems like a little bit more of a sure thing trade than some of their own productions over the last couple of years.
Yeah, so two things there, production and then any worry risk. So 24 will be a little choppy quarter over quarter on content spending. Last year, because of the strike, you went down to 13 billion. Their normalized spend, and it's been that for a few years, is 17 billion, and they get a high ROE on that spend compared to others like Disney that spend so much more. Related to risk, it would be any shortfall or disappointment in some of the new areas of growth, such as advertising or the ad pay plan. Lastly, the important metric that we all like to see is free cash flow. And that one, I think there's probably going to be guidance for a pretty good number for 24.
All right. Great stuff, Ken. Thanks for the prep. Appreciate it.
Yeah, okay.
Kenneth Leon, Global Director, Industry and Equity Research with the bull case for Netflix. Tom's got two ways to trade it, Mr. White. Bullish and then kind of a more hedged strategy. Let's start with the more bullish one.
Yeah, more bullish one. I think you kind of have to look at this stock from a perspective of what it's going to do during earnings, right? Historically, we've had really massive moves, sometimes a 2-3 standard deviation move post earnings. This one's priced in about a plus or minus 8% move according to the option pricing at this point. That's about $38 or so either way. So there is that potential for a big move. Stock was up 65% last year, so it's elevated. But if you take that chart out and look at a 3 or 4 year chart, you realize that this stock was $700 at one time. So keep that in mind.
Yep.
So I looked at something in the skewed or broken wing butterfly family to the upside, where I can, instead of buying a vertical or just buying a call outright, I can offset some of my costs with the expectations that, hey, it can go up, but maybe it doesn't explode to the upside 2 or 3 standard deviations. So going out to the February 2nd weekly cycle, so not a pure earnings play. I'm giving myself 10 days, so you'll have some time in case the stock does pull back for it to rebound if that's what happens. So buying an in-the-money call, the 485 strike call one time. Selling 2 of the 510 strike calls.
Okay.
That's kind of the apex where you want it to go. And then buying 1 of the 515 calls. So in essence, you're buying a $25 wide bullish call vertical offset by a short $5 wide call vertical with that same common 510 strike that you sold 2 options on. Paying roughly about an $870 debit. It might be a little bit higher. The stock's moved up to $492 here. But if you pay an $870 debit, there's your risk, $870. You see from the risk profile, it tops out at more than a double at or near that 510. But even because you're paying $870 for it, even if it goes above that 515 strike, you're still having more than a double in profitability on this type of trade, and you're paying less of a debit for that. Now, the stock's already $7, or that 485 call still already $7 in the money at that point. So that break even, which is about $493.70 to the upside, that's less than 1% above the current share price. So you don't need a massive move, but this is definitely a bullish trade, giving yourself about a week and a half.
All right. So you've got a perfect point there that you want to hit for this trade, but generally as long as you get about $4, you start making money.
Yep.
For it. Your other approach, how does it differ?
Well, you're taking advantage of the higher implied volatility on this one because you're selling in a neutral to bullish strategy, selling an out of the money short put vertical. But I gave myself some duration on this one, about 24 days, because maybe the stock does react negatively initially. We've seen that out of some earnings reports. Even though they beat, the bar's been set so high, they pull back a little bit. So this one's got about 24 days till expiration, where I'm going to take advantage of that higher implied volatility and also giving myself a better probability of success. So I went out to the February 16th monthly cycle, 24 days to expiration, selling the 465 strike put, and then making it risk defined in case the stock does fall, buying the 455 strike put, so creating a short $10 wide neutral to bullish put vertical, collecting roughly about $3 credit. So that takes your break even down to 462 over the next 3.5 weeks. That's about 5.5%, 6% below the current share price in here in Netflix. The probability that that short 465 strike will be out of the money at expiration is over 65%. That's what you want, higher probability of success, giving yourself that cushion, and you profit in 3 out of 4 scenarios on this one.
All right. Okay. Makes sense.
Yeah.
So sell the downside if you want a little bit of a safer trade, betting against the breakdown. Use your other trade if you're looking for more of a pop.
Yep.
All right. Thanks, Tom. 2 bullish approaches in Netflix after the bullish commentary from Ken Leon.